Hello, and welcome to the Wallfacer Labs podcast. Today's guest is Alan Keegan. Alan is the co-founder and chief strategy officer of Memory Labs, the company building the Kinto network. Kinto is a soon-to-be-launched Layer 2 with user permissioning built into the base layer. Prior to that, Alan worked at numerous companies, including Bridgewater Associates and Sense Finance. Alan, welcome to the show.
Great to be here. First time ever doing a podcast, I think.
Really?
Yeah.
Well, I'm glad to have the honor of being the host. So, I'd love to start with an intro of just what is Kinto?
Yeah, can I give a longish form answer to that, or are you looking for like a elevator pitch, one sentence thing?
I've got basically an unlimited amount of time on my calendar today, so take as long as you want.
Okay. The very short answer is we're a KYC layer 2. We're a fork of the Arbitrum stack. We're actually going to be the first new L2 that is forking our technology due to some internal changes they had there, which is pretty exciting. Why any of that matters is probably a little bit something that requires context. At a high level, part of it is just solving what we think are the two biggest problems for user adoption of crypto. One is weird crypto UX nonsense, which we solve because we have native account abstraction, which is something we can discuss exactly what that means and why that matters later. But the basic answer there is that you get to use a crypto network, experience self-custody, interact with open infrastructure on chain, all without any of the sort of weird crypto onboarding stuff that a lot of us kind of forget is super weird for non-crypto folks to use, like, private key and like a 12-word passphrase that somebody can use to take all your stuff. Like, none of that. You can just use your device biometrics and 2FA or something if that's what you would rather do. If you want to use your hardware wallet or whatever as a signer for your Kinto wallet, you can do that. And then the other is user safety, where by having insurance at network level, as well as having, universal KYC, we have the ability to basically make it a much safer environment to participate in the crypto economy. And at the same time, through, our own innovation of what we call user-owned KYC, we can do the all-protected user privacy, where you have to go through a KYC verification to have a wallet, which creates a much safer environment, but you can pick which provider is storing that personal information they're using to do the KYC. None of that's available on chain. So people on chain still can't see any of your information. And you have the ability to share that with protocols and financial services platforms that you want to use if they have to do a KYC checkup of some kind. But that is only shared with the explicit permission of the user. A lot of the origin of this actually came initially from myself and my co-founder both have known some of the folks that run the SALT conference, which is a large financial conference, for a long time. As you mentioned, for me, my background originally was in traditional finance. The conversation that they've had and we had with a bunch of folks within that network, which is, most of the largest financial institutions in the world, we basically discovered that there's really two things on their side that keep them from participating in crypto, because it seemed a bit odd that there isn't more institutional participation. Usually if you have a new market like this, they'll be doing the stuff financial institutions do, deploying capital to this market, raising capital from this market, providing services to capital for fees in this market. And there wasn't really much of that going on. And we kind of identified that most of the issues holding them back boiled down to two concerns. One, financial risk, but financial risk specifically in the context of smart contract risk. If you know anything about crypto, you know that there's been a lot of exploits, and it's something that they can't, understand well enough to underwrite, and something that they need to be in an environment where that's a lower risk. Obviously, having a totally KYC network helps address some of that concerns, as well as having this network-wide insurance. And the other concern they have is largely compliance risk, and most of the compliance risk is centered around concerns regarding know your customer and know your transaction stuff. And that exists at many levels, and it's really hard to solve on existing chains, where a lot of these folks don't even want to hold capital on a chain where they can receive funds from a sanctioned entity. Like, I don't know if you would recall this, but back when Tomato Cash was added to the OFAC sanctions list, there was a bunch of articles about how this guy, sort of troll activist, however you want to interpret it, went and dusted a bunch of famous people's wallets with sanctioned funds, and that's more of a headache than a lot of compliance departments are willing to even open up as a possibility. But then even if they are on chain, it's hard for them to interact with any existing pools of capital. They can't really go just lend on Aave if they can't demonstrate, for example, like Lazarus Group is not any of the borrowers on Aave. And this is why we sort of have this life cycle of people who get hired to be the head of digital assets at these financial institutions, where they get hired. This has varied. Now they're much more sophisticated. Back in the last bear market in 2019 and stuff, when they kind of were starting to do this, they were just hiring some, or giving the role to some MD who's son known to Bitcoin or something. Now, a lot of these, even traditional finance institutions are really sophisticated. A lot of them aren't in blockchain, but a lot of them are. And in any case, what happens is that they hire somebody to be head of digital assets. That person does a bunch of research. They want to build something, usually on Ethereum, in their innovations team or some kind of pilot program. And at some point in that process, that entire project just gets absolutely laughed out of the room by their compliance department, which is why you see these folks sort of building these private blockchains, because that's the way they can have all participants be KYC'd and feel as though there's a safer environment. But at which point, there's not really that much point of doing a blockchain. They aren't really doing anything that they can't already do, and they are interacting with any new market or pools of capital.
Right. All right. You touched on a bunch of interesting concepts there. So let me go back to one. So in terms of institutions getting involved on an Aave pool or something, I've always seen this as oversimplification, but there's 3 levels here, right? There is a fully permissionless pool where you have no idea who the counterparties are, either lending alongside you or borrowing your capital. Then there's this kind of negative test almost, where you can use a tool like Chainalysis to screen the pool, make sure that no one in the pool on the lender or borrower side is on any kind of sanctions list or any sort of negative list. And then there's maybe this final level here, this highest level of compliance, which is some kind of version of a positive test. And so there are protocols like, say, TrueFi or Centrifuge, which only allow KYC lenders to participate in a pool. There's things like Violet, which I think are DEXs that only allow for swaps. And then in this case, Kinto is really kind of the most broad sense of this, where it's a whole chain where there is this positive test essentially happening where that everyone alongside you has done some kind of KYC and is not on a sanctions list. Is that a fair framing for how to think about that?
Yeah, and I'll add a couple of thoughts on here, because we also layer in a lot of other stuff on Kinto. We're going to have chain analysis operating on our bridges. We'll have folks like Hypernative, looking for sketchy transactions and all that stuff. But part of the problem with doing this at the product level or the protocol level versus at the chain level is that, and this is something that came up, when we were doing our seed round, when we talked to crypto VCs, they're like, oh, can't people just create a pool of only KYC users? And the answer is kind of no. No TradFi institution that we talked to suggested that as an alternative, because it's also that nobody who can receive capital from, nobody who can deploy code that is what you're interacting with, or that can interact with what you're interacting with, is not KYC. And so a lot of that has to do with, a lot of the benefit is unlocked by doing it first, by doing it at the chain level. And then the difficult part, and part of what we're, one of our sort of driving design principles is doing that, having that KYC at the chain level while still being decentralized, while still being permissionless, where this is very different from, say, an Avalanche subnet, where they, have a whitelist of who can participate in it. Anybody can come and KYC and use Kinto, and you can pick which provider is storing your data. So you can only do it, you can choose to only do it if there's a provider that you're comfortable with.
Okay, so you open up 4 different questions for me here. One, I guess, would be just comparing to some of the other solutions in the market. So you allude to something like an Avalanche subnet there, which I think is probably the other leading solution for kind of a KYC chain. I don't like that term. I'm sure you don't like that term either. But where does the differences kind of stack up against something like that? And are there other solutions in the market as well? And how do you think about where you're differentiating? And also just kind of this point around permissionless, I'll come back to as well in a second.
Yeah, I think that part of it is, and then this goes into how we came about doing Kinto to begin with. But we basically discovered that it's important to do the KYC at the network level. And then also, in order to have a network that is open and permissionless and can interact with the existing infrastructure and pools in DeFi, we wanted to be EVM compatible, and we wanted to be attached to Ethereum, hence an L2.
Yes.
One of the things that I think is really interesting about L2s, as it exists right now, the major L2s are all sort of cheaper, faster versions of the EVM. You're Matic, Optimism, Arbitrum, which are differentiated in arcane technical ways about who has interactive fraud proofs, who doesn't, this one has slightly higher throughput, etc. But from a user perspective, they're all kind of the same product. One of the benefits of L2 is that this is a way of doing stuff like what we're doing, where we make minimum compromises on decentralization, etc., in order to unlock the benefit of use cases that you can only do with compliance. If you take something like Avalanche subnets, they have obviously one big difference is that they're attached to the Avalanche ecosystem rather than Ethereum ecosystem. But then from a strategic approach, they are whitelisted from my understanding, and so they're only basically going directly to institutional clients. What we're trying to build is something that is still open, that anybody can use. We already have thousands of users who have like pre-verified in KYC in our launch program. As of this recording, we're going to be opening up a bunch more spots tomorrow. I don't know when this comes out, but there'll be thousands more by the time this comes out probably. And like we also like this isn't just about like servicing institutions. This is about breaking down all the barriers between the benefits of traditional finance and keeping all the benefits of crypto. Like at least for me, like as we speak right now, I transferred some money in an ACH to a centralized exchange in order to buy something that I then wanted to bring back and do some stuff on crypto with, and that ACH is taking 4 to 5 days to clear. But like that's super annoying. But also like if I wanted to go rebalance some like ETH into like some equities, I have to go through like 3 or 4 transactions over the course of like 4 to 5 days and pay fees to all those middlemen in order to do that. But like the cooler use cases come from sort of the like end state, ideally, in things where you can basically go be taking out mortgages on chain. But even before then, when you could start doing stuff like using treasury or tokenized treasuries as collateral on perps dexes, issuing pegged assets against tokenized real world assets, using real world assets as collateral to then borrow and do things on crypto, to be able to deposit ETH, borrow against it on Aave, and then deploy that into some higher yielding, real world asset product. So one of the big things here is I feel like at least in terms of what I've seen getting built on things like Avalanche subnets, they're a little bit less different from the sort of private blockchains that the TradFi institutions are bringing, whereas like we're many more notches towards being totally permissionless and open than they are, which I think permissionless networks, open networks win because anybody can come build on Kinto. As far as like the wider universe of solutions, there's also doing KYC just at the wallet level. I think that there's some benefit to that, but again, that doesn't unlock use cases in the same way doing it at the chain level does, where because, for example, we're doing the KYC at the chain level, even though none of the personal information is stored on chain, relevant things for transfer restrictions are stored on chain. So you can choose to have, go through an accreditation process and have anybody on chain be able to see that you're accredited or from a certain jurisdiction, et cetera, which is kind of necessary where like right now the real world asset space is largely isolated pools that you can't do much with. There's a few exceptions that we could talk through in terms of like Flux, and then the constraints that has only be people who are direct users of Ondo, who can actually go deposit the collateral beyond being, have to be qualified purchasers, and like Maker, which is its own whole complicated thing. But like you can't really go build open infrastructure for real world assets on Ethereum mainnet because those real world assets don't have a way of ensuring, say, if you have like a bunch of equities used as collateral on Aave and you have a liquidation, they have open liquidations, you got to make sure Lazarus Group doesn't buy those equities, or a U.S. person, or a non-accredited investor, like whatever the relevant transfer restrictions are given your own jurisdiction and, specific issuance and stuff. Once you can check that stuff on chain, that can be enforced by the token such that it can go interact however you want with open infrastructure. And then you can actually be building DeFi infrastructure for real world assets rather than just having to build or build DeFi infrastructure that also works for real world assets, I should say, rather than having to go build these sort of like isolated pools. And I mean, on one hand, people have this thing where they say like real world assets is like a bear market narrative. Holding isolated pools of treasuries for 5% yield on chain is a bear market narrative, but like I think like the future of real world assets is much broader than that.
That was a good nuanced take on that bear market point there. But that kind of broader thing around the composability of some of these things is what initially got me interested in Kinto. I think maybe if you remember, we're in that RWA group chat, you posted about what you guys were building. I'm guessing I was probably like one of the first people to reach out just because, the thing that we had seen for so long at TrueFi and that I've seen with other RWA protocols is that generally speaking, they are completely removed from the rest of the DeFi market. They're not accepted as collateral at any large over-collateralized lending venues. There's no liquidity for them on AMM markets. They're not accepted as collateral on perpetual dexes, whatever it is. They just completely live in their own world from the rest of DeFi. And largely speaking, I think that's held back the growth of any kind of RWA assets, LP tokens throughout the ecosystem, just because they're so segmented. And so to the extent that Kinto can get the issuers of these on-chain assets comfortable with, allowing transferability, allowing them to be accepted as collateral at these different places, that is where I kind of see the big unlock for some of these assets and these issuers. There's a second side to this, though, which I guess is the investor/lender LP in some of these opportunities. How have you guys thought about that opportunity? Are you focused on a lot of the same, sort of hot ball of money crypto people? Are you focused more on institutions? How do you think about attracting capital to the chain?
Yeah, let me talk to the first point first, and then, if by the time I finish answering that, I forget about the second one, you can remind me. But to talk to the first point, I mean, it's interesting. I like, first of all, given the many constraints that real world assets suffer on chain, like not being able to be used in basically any kind of like on chain DeFi infrastructure, and just having a horrible onboarding UX because you have to go through KYC to do any of them, and even to the degree there exists such a thing as like a real world asset user who wants to use all of these real world asset protocols, they have to go redo that KYC for all of them. Credit to the real world asset space of all these folks that have just been grinding at this for many years and have like slowly ground up the AUM for real world assets to like 1.5 billion-ish, I think it is now. But I also, that can't hockey stick until you actually get to do stuff with these things on chain. And this is something that like we've described before as sort of the oil and water separation between, DeFi and TradFi. And like in my initial talking about Kinto, this is something that like I often like focus on because like chronologically and like just like as far as like how I came to the Kinto idea, although it actually came more from the safety side and how to make DeFi safer from my co-founder. I often talk about like these TradFi institutional players first who care about counterparty risk, but like that's not really our primary focus right now. Like our primary focus right now is these real world asset protocols and making their onboarding UX way easier because people can use their existing, Kinto KYC to make that onboarding significantly easier, and then unlocking, composability and transferability for them. Like that's actually what we're doing today, because the people who are actually trying to bridge this gap right now are these real world asset startups. And like I 100% agree. This is something that like came out immediately when we started talking to folks that like the burning problem that Kinto solves right now is for these real world asset issuers, which is why we have a bunch of launch partners. Like heading into launch, we have 20 some protocols that are going to be launching real world assets on Kinto or infrastructure for real world assets on Kinto, et cetera. Is I think that like there's a consensus in the real world asset space that like the step change or like order of magnitude explosion in real world assets doesn't come until you can do things with them. And then like a lot of the reasons you can't do things with them is that in the same oil and water separation there is between these, potential entities and pools of capital that, care about compliance and KYC and stuff, the assets, like the products themselves sometimes care about compliance and KYC, and all these real world asset protocols are basically fighting the uphill battle of trying to build a compliant product in a fundamentally non-compliant environment. And then until they're given the compliance tooling to be able to make those things operable on chain, they can't really do the things that blockchains are good at doing in terms of like composability, accessing new pools of capital, and like open infrastructure. And the second question was around like who's the audience here. And
let me let me try to rephrase that a little bit if I can.
Yeah.
But let me see if I understand this correctly. You can agree or disagree with this, right? I see the opportunity that you guys are laying out kind of to what you said in the beginning of there are institutions that have the blockchain guy within the company. They want to do something, and then they get kind of skittish when it comes to actually doing something on a fully permissionless chain. So I think it's very clear to me that there is an opportunity to attract those kinds of people to Kinto. I guess what I'm curious about is, does that wind up being the core focus? Are you also focused on kind of the hot ball of money crypto people that jump around and are always seeking high yields? Like, how do you think about that go-to-market of attracting capital?
Expand and fragment the crypto audience a little bit here. I think that like, chasing the hot ball of money crypto people in general is a losing game, depending on what type of game you're trying to play. If you're trying to play a long-term game, chasing that hot ball of money people is a losing game. But for crypto, I think that we like the audience that we want for crypto is people who want a safer environment in which to operate. Like the next phase of our pre-launch program is going to be awarding credits to anybody who has been exposed to a major DeFi exploit, to attract them to an environment where these exploits are less likely. And then obviously we want to have like the main exciting thing about Kinto going forward is that there is design space opened up by this that is not possible in other places, like doing loop borrowing against treasuries rather than doing loop borrowing against like STETH for example, or types of like stable coins where you can kind of be your own circle where you're holding a stable coin, but you also own the collateral that it was issued against, so you're also earning that yield as a cash rate underlying whatever else you're doing on chain. And like these are all things I think are like attractive to crypto people. we are going down like multiple roads at the moment in terms of like who the capital deployers are. And I think that with the TradFi folks, there's a separation here between, and it's something we've spent less time focusing on because we've been so overwhelmed with interest from like RWA startups, but is 100% on our roadmap is more the innovation teams in like these like TradFi companies that are building things in these private blockchains because they can't build stuff on Ethereum. But these are slower moving folks. It's like a slower sales cycle, so to speak, to get them to use our tech. And then there's capital deployers, where the value prop to a capital deployer of deploying capital on Kinto is especially one that is, say, the crypto team of a family office or is a more traditional finance firm and not even necessarily like a crypto fund. Is like, yes, you can go just hold something that you're familiar with to begin with, and collect some Kinto rewards pending approval of the draft mining proposal and stuff you can find on our website. And then like you have to get comfortable with like the structuring of the tokenized underlying asset, but to the degree that you are and you're okay with the fees and you're comfortable with holding this stuff on chain, in part because the UX is now completely abstracted away from a lot of the weird crypto stuff, and you're in an environment where you also know that there's way less likely to be hackers because everybody's KYC'd, et cetera, then you get to basically hold this underlying asset that has no principal downside exposure to crypto. You're holding a token version of like a treasury with some kind of recourse directly to the underlying, and you hold treasuries anyway. And then you're accruing some exposure upside to this, L2 token that presumably has some crypto beta, right? The process from there is going to be more about taking that and then where's the upsell? And the upsell is all about having that infrastructure built on chain in order for people to be able to borrow against those treasuries at low treasury rates, which is crazy, or be able to go deposit those treasuries to issue a claim that they can then sell, which allows them to operate on chain and do a bunch of other stuff, or use those treasuries as, again, as I mentioned before, collateral on like a perps DEX, or like one, project we recently signed as a launch partner is Resonate, and they're basically doing yield stripping on treasuries. So let's say you're planning to go hold treasuries on Kinto for a year, you can basically sell that yield ahead of time, keep your claim to the principal, redeem for your principal in a year, plus any rewards or whatever you might have accrued, and then do something else with the cash in the meantime. Maybe go do some weird crypto stuff and try it out, and then fall down the crypto rabbit hole. I think that people underestimate the degree to which like people who are on the investment teams of like a family office or a fund or whatever are also just people that are entirely as capable of falling down a crypto rabbit hole as any of us are.
Interesting. So I guess coming back to that point a bit around kind of institutions versus retail, maybe. Actually, before this, I was reading an old Arthur Hayes blog post, and he kind of outlined a I would say slightly bearish case for more KYC types of opportunities. And I think his crux was that retail investors, which generally drive crypto today, don't need, for example, to trade against institution because this surprising amount of liquidity exists in the crypto markets. And that there's a chance that, these more permission, KYC gated opportunities wind up being kind of like mostly institutions trading against each other. And actually, I'll share another anecdote, which is actually back in the day, I had talked to Kyle Davies from 3 Arrows. I hope he's doing okay now. And, he'd outlined this kind of difference of traditional markets versus crypto markets, where in traditional markets, the liquidity stack is, you have like sovereigns, you have banks, you have hedge funds, then at the very top, you have this tiny kind of retail sliver. And that crypto is kind of the inverse of that, where you have this retail sliver that is the bulk of the liquidity. Sovereigns don't really exist, banks don't really exist, and then you kind of have hedge funds. How does this whole kind of liquidity thing, because I think the initial go-to-market here will be a little bit different for you guys here. And so maybe you do have the place where, probably not sovereigns, but maybe something closer to a bank or traditional institutions do make up a bigger chunk of that liquidity?
Yeah, I think end state, yes. I think that probably out of the gate, one thing like we have been surprised at the amount of retail interest we've had. Like we released 10,000 spots for people to sign up, which we expected to last like a week, and it was gone in 24 hours. So like, one, we're finding out the answer to that also as we go. Like there's a lot more retail interest even than we had originally anticipated. But like the way I can frame this in terms of like something else that I think about a fair amount. So like I think, yes, out of the gate, a lot of retail over time. Like it just is the case that the largest pools of capital in the world are the ones that do care about things like, knowing who their counterparty is, or knowing that their counterparty is not on a sanctions list. But like these are like fundamental needs for larger pools of capital, which is part of why those pools of capital are not in crypto. And then the point of like trading against them, there are plenty of smart people doing things like MEV that you're getting wrecked by trading crypto as it is. But like for example, like one thing that we're not doing is we are not, trying to fork Uniswap and like fork Aave and like have our own DEX or whatever and like have fragmented liquidity. Instead, what we're going with is just like having cross-chain functionality out of the gate so that you can access the pools of capital. And like for me, I don't really care about counterparties. I'll just do that and access the liquidity that exists on L1 rather than like fragmenting liquidity onto our L2. And then to the degree that you care about counterparty risk and you still want to access that, market makers can intermediate that on Kinto. But then like the positioning thing here is that to the degree that that thesis is right, those people will do stuff on chain once they have their compliance needs met. Then there is more, like the market for liquidity is larger for us, I think, than it is for a non, like for Ethereum. Like for example, like if you're Aave or Uniswap or whatever, and you already have a huge market share in your particular vertical, there's two things you can do to grow your business. You either launch other products into other verticals, and I think Uniswap's done some of that, or you grow the size of the market that you address. Both of them have made attempts at this, like in the direction of accessing people who have higher compliance burdens. You had Aave do its ARC product. Problem with that, yes, you can go KYC 30 entities that can already make loans to each other and have them do it through Aave, but there's no reason for them to do it through Aave because there's no new lenders getting introduced to that pool. And you have the sort of like tag, I think, for Uniswap X for KYC stuff. But at a certain point, if we develop a permissionless ecosystem with a bunch of existing infrastructure, with real-world asset protocols, with activity and users and an audience that includes both a large portion of the crypto retail users who are interacting with real-world assets and stuff on our chain and then going cross-chain for other stuff, and we're on board in these institutions, then the easiest way for you as a DeFi protocol, it doesn't necessarily itself require KYC in the way real-world asset protocols do now, but wants to access a market that cares about that. To be able to access that market is just to go deploy on Kinto.
Got it. So I'd like to come back to the bridging point, but before I forget my other question, applications that will deploy on Kinto. Do you imagine that a lot of the leading applications will be things? So like, for example, if you look at Optimism mainnet today, or let's take Optimism mainnet, I think the biggest application there is just Uniswap, right? Which is also the biggest application or one of the biggest applications on ETH1. Do you imagine that will be the case on a place like Kinto as well? Or do you think it will be net new applications? Do you think it will be RWA applications that maybe exist on an L1 today, but haven't reached their full potential? How do you see that?
I think that changes over time. I think that short term, and again, I'm speculating here and where we're learning as we go, right?
Yeah.
Short term.
Not advice, blah, blah, blah. Yeah.
Short term, probably real asset protocols that already exist in other places because there's a benefit to them out of the gate from deploying on Kinto, and there's benefit to users for using them on Kinto with like easier onboarding experience and stuff. And so like that is like the obvious thing where even in a world where right now Kinto is not live, nobody can use it. The second we're live, we're delivering value to that use case that already exists. People have already built. And I think that like the biggest value we unlock immediately after that is sort of protocols that are infrastructure that interact with real world assets that you can't really build on other chains. So that's kind of the stuff that only exists on Kinto. The combination of those things, I think, gives us access and a unique value prop for stuff you also can't really do or cannot do as easily or cheaply off-chain to be able to do them on-chain. That is actually like a real, we have to go use Kinto to do this thing, and we can without like, our compliance, like a head of compliance quitting or whatever for like more traditional finance institutions. And once we have more traditional finance institutions, it makes sense that the things that are just some of the biggest use cases in crypto become the biggest use cases on Kinto, because like, let's say Kinto has the only DEX where you can collateralize tokenized treasuries or perp DEX, right? Like the overlap of people who care who their counterparties are on a trade and also care about the incremental yield of their collateral being treasuries versus just like stable coins is probably pretty high. And they represent a lot of flow. And then like, then we get into like the, crypto utopian future, which is like eventually I think basically the entire financial system runs on crypto rails, ideally our rails. And then at that point, just whatever is the largest use case in finance is the largest use case on Kinto.
Well, so you've touched on this a bit then,
but all the sovereign bonds on Kinto is the
Right. Right. So you've touched on this a bit, but I was going to ask what the main benefits of building on Kinto are, but maybe I can kind of summarize it, which is there are some things today that can't be, for an application developer, there are some things today that can't be done on a fully permissionless chain, whether it's around transferability of RWAs or accepting RWA collateral. And those are big enough markets that will also attract very large institutions, ideally, and thus, can kind of increase the total utility and overall market opportunity for some of these teams. Plus, I think there's a lot of safety considerations that probably or maybe
I don't want to undersell our UX benefits too. I think native account abstraction, that'll probably become much more universal in crypto in general. Yeah, I think that we're early on that in terms of native account abstraction, and of course the safety thing, and to some degree it's going to take years of data to prove that out. Yeah, 5 years from now is the percent of dollars lost in Kinto $1 for every $100 on Ethereum controlled for TVL or whatever it is. I don't know how that works out. It is always possible to have exploits. It just seems like it would be significantly harder on a chain where you have to KYC to do the exploit. Yeah. Not everybody's going to be the Mango hacker guy who's just yeah, that was me, I did that.
Yeah. So talk to me more about account abstraction there as well, right? How does that, let's say you're an existing crypto user and you're very familiar with all the clunkiness. Where do you or I, in that case, kind of see the benefit of account abstraction wallets?
So that is, me. It was one of those things where I guess one thing it's so hard not to become blind to how unusable this stuff is to folks who haven't been doing it for years.
I was going to say, I definitely have some Stockholm syndrome where I've grown to actually like some of these weird things that maybe take an extra step or whatever to do a transaction because it has this kind of certainty and finality that now when I do, for example, I've had to send international wires recently for the first time. And it's so strange to me that people don't want a test transaction. I've said to people, hey, do you mind if I send a test amount first before I send the full amount? And they're like, why would you do that? Just send us the full amount. Because you gave me these weird numbers and this doesn't seem right to me that I can just send this to you internationally and you're going to get it.
I mean,
we
can go to a whole aside on my thoughts around the development of the existing financial system and why it kind of is so inefficient the way it is. But I totally forgot where we're going. Oh yeah, but the way that actually work. Yeah. So is that you set up a Kinto wallet. The Kinto wallet you add signers to, and so those signers can be just I'm going to use the finger scan on my phone, the thumb fingerprint thing, and then a 2FA code, or it could be I'm going to use my hardware wallet and a MetaMask. It can be anything.
Okay, interesting. So for new people, having the flow of the thumbprint or face scan, whatever, is so much more familiar in terms of the financial experience they're used to with Wealthfront or Robinhood or whatever that might be.
Yeah, I mean, something that I often say is that right now, most people using their brokerage account or their bank account know nothing about the role of custodians and transfer agents, et cetera, in making transactions happen. And they shouldn't. In a world in which you have to be a financial expert in order to benefit from the existing financial system, that's a fail case for a society. And a lot of our financial system is around reducing your own need to do things like decide whether your bank is trustworthy, with FDIC and stuff. That's have been painful lessons learned over time. And in the world where a lot of these sort of back-end functions of the financial system are, done by blockchains, you need to do it in a way where the person doesn't have to understand how blockchains work in order to use them.
Yeah, and well, actually, a question for you. So I think the kind of whole, passkey flow of funds and all of that is probably very familiar for individuals. But for institutions, I mean, I don't imagine they were using passkeys. What is the UX improvement that takes place for them?
Well, it kind of depends. I mean, for a lot of them, they have sort of custodians that they work through, or connections Fireblocks and stuff. So it goes through integrations with that. Going forward for new ones, what that looks like, I think is still kind of getting figured out. Some of them might actually end up using hardware wallets and stuff to the degree they have rules that happen to do their own self-custody, but the services that are equivalents of your existing, Fireblocks and stuff that are going to get built on top of this kind of system probably look a little different.
Okay. All right, yeah, I'm curious to see how that shakes out, because I think some, I guess you could say, kind of claim I've come across a lot that I don't understand how people make this claim credibly is Today I don't actually think there is a lot of cost savings for people who are using crypto, like traditional institutions using crypto to originate assets or whatever it might be. Mm-hmm. And often I think that comes from, they have to set up new custodians and financial partners that I don't know this for a fact, but I will imagine that crypto custody is far more expensive than traditional asset custody. So there's all of these kind of new costs, new security you need to get set up, all this kind of stuff. And I think actually there's a lot of friction there maybe that, I don't know if you guys can plug into more of these traditional custodial type of setups, that maybe there's actually some real benefit there for institutions.
That's totally true, especially for like really basic use cases. Like if you're holding treasuries in size at UBS, you're maybe paying 10 bips. I don't think there's a tokenized treasury product that does that. A lot of them hold it through the ETF, which takes its own fees as well. And then even like a couple that don't, they're not going to have that attractive of fees, right? So like there isn't that much reason to just hold treasuries on chain other than if you're getting access to like rewards and stuff, or you're kind of doing it as like an experiment. I think that when we start unlocking real benefits here is when we can do complex transactions more quickly and cheaply than people can do elsewhere, where maybe some kind of thing that you're doing. Oh, there is like a cheapness thing. There have been plenty of times where borrowing on Aave has been cheaper than borrowing like basically anywhere else in the world, where like somebody with like enough ETH to over collateralize something by whatever 50% is like, according to market pricing, like a lower credit risk than the US government. But like by and large, I think that there are sort of transactions that might take days and thousands of dollars of lawyers' fees to happen that can just be run through a smart contract.
Totally.
The cost of an L2 transaction.
Okay, so two things, and then I want to jump around a bit to some of your background and then end on Kinto. First one, though, was you mentioned this point about bridging, and I'm trying to just make sure our listeners understand. So there will be the opportunity for someone to hold assets on Kinto, but still participate, in opportunities in other ecosystems via some sort of bridge, or what is that system exactly? How does that work?
Yeah, that's it basically. There are a bunch of existing like cross-chain protocols, like Wormhole, Layer 0, and that kind of thing. We're going to integrate probably with multiple of them before launch. We're currently looking at their various integration fees, etc. I think that's also going to be sort of the standard in the future, like cross-chain by default.
Now that doesn't violate any of the, I guess, compliance concerns that someone on Kinto could have.
That's where this, and we have like an internal working name for this that I am going to stop saying because there exists a protocol that already has that name, so we can't use it. But like one of the functionalities we are building into Kinto is that, so like me, I can just go trade with, stuff on L1. I don't care. I'm not somebody who has like a compliance burden. But if I am, some TradFi institution that does have a compliance burden in that sense, I can instead then go kind of use like an RFQ system to post a trade I'd like to do, and then a market maker can quote me something close to that, and then I interact with the market maker who is KYB'd on Kinto rather than interacting directly on L1. This is something that like those market makers, for example, are already operating on chain and also on centralized exchanges, right? And then there is, with Chainalysis, a bit of like look back on analysis of stuff that is capital coming into the chain. So we do have Chainalysis looking at the bridges to make sure that somebody didn't just like sell a bunch of weapons to criminals and then like use it to buy treasuries on Kinto. That's what they would do. I don't know. But the KYC starts at the bridge. Yeah.
So somewhat related to that is kind of around this balancing of the ethos of, hardcore crypto with the benefits you're offering around security and a higher level of certainty around counterparties, or KYC kind of simply. Mm-hmm. Like, what's your kind of steel man, I suppose, for, the hardcore crypto, open source, decentralization maximalist, and kind of like how do you convince someone like that to be open-minded to Kinto today? Assuming they're willing to be open-minded, right? We have to.
I feel like that. There's a long tail of that, and like it goes pretty far out there. Like one of like the folks I know, like their brother has never even KYC'd to open a bank account, and like he's not going to use Kinto. Like, sure, yeah, not for you, I guess, if that's the case. That's for people who are in crypto have KYC to centralized exchanges or something, and like the way that it's done is such that you control completely your private information still. And it's not shared with anybody without your permission. In fact, the way it's implemented, even the KYC provider doesn't have the key pair. So, if you KYC with Plaid and then Plaid was hacked, that doesn't dox your on-chain ID. They can't go match it back to your address. But like, if you're just like hardcore, I'm not going to touch anything that, involves any kind of regulatory anything.
Yeah, so not that far out in the spectrum. Someone that's maybe a little more middle ground.
Like, for example, like one of our like if you've KYC'd for a ton of stuff, you've probably already KYC'd with Plaid before. If you've KYC'd in some jurisdictions, I think like in Korea, like for Binance, wouldn't quote me on that, but like Synapse, which is another one of our KYC providers, is a KYC provider for a lot of crypto companies. So like if you've done crypto KYC, you may have already KYC'd with them before. And also, like I said before, like this is something that we thought was going to be much more of a discussion of like explaining how we're maintaining being permissionless, maintaining privacy, and maintaining being decentralized and self-custodied, while also unlocking the benefits of having a chain that has KYC and like compliance tooling integrated at the chain level. And that we've just gotten a lot less pushback on that than we expected. That was something that we were like really braced for. And like I said before, we've actually gotten much more crypto retail interest than we anticipated.
Well, you've said this a few times, and I imagine this will confuse people who are listening, but you've described yourself as permissionless while also having this KYC element. So when you talk about that, you're talking about what exactly, right? Just what people would come to expect of like a decentralized kind of sequencer process, or elements of the chain, or onboarding KYC providers. What do you mean when you say permissionless there?
Yeah, I want to I think a big part of that is sort of distinguishing us from like whitelisted products. Like we're not like an Avalanche subnet. Like we're not a permissioned whitelisted product. Anybody can come do stuff on Kinto. You don't have to like get approval from like Memory Labs, like use Kinto. Like anybody can come, you pick a KYC provider, go through the KYC process, and you can use it.
So long as the KYC provider supports said country or jurisdiction.
Yeah. And that's when
that's okay.
Pre-launch, we have limitations on which jurisdictions we can do. We're going to be expanding that over time. We have additional providers and, just like further integrations.
Okay. All right. So that makes sense. So let's jump around a bit. I realize we jumped right in on Kinto, and people listening have no idea who Alan is himself. Tell us a little bit about your background. What did you do out of school, or, wherever you think is a good place to start.
Yeah.
And I'll pepper in with some other stuff too.
I can also sort of get to how I ended up in crypto stuff.
We'll get there.
Yeah, I got to school. I worked at Bridgewater. I did not study finance in school. I studied political theory, just like political philosophy, basically. And I interned at Bridgewater. I thought it was like super interesting. I saw a lot of analog between doing like finance stuff and political theory, where like in my mind, political theory is about you make some assumptions about what people are like, and you come up with like an outcome you want, and then you design a system organizing people to reach that outcome. And then, finance is a little bit more, especially like macro finance. You make some assumptions about what, people and actors in a system are like. You look at how they are set up, and then you predict outcomes. And at Bridgewater, I was on the FX team and the macro team. It was actually partially because of Bridgewater that I ended up interested in crypto. Part of it was I just met a lot of folks totally unrelated to anything, just like at like a music festival, I think, who were like some of the first like 10 employees at Consensus, and like heard a lot about Ethereum. Super interesting. And I like vaguely heard about Bitcoin before. So like I learned a lot of stuff about the Ethereum ecosystem really early on. But then also another big catalyst is I think it was in 2015 when the yuan started floating the peg, and there was like a 1.5% devaluation. This is when I was on the currency team, I think, and that was like a big deal at the time. And one of the big indicators for like capital flows out of China, and they had like implemented capital controls shortly after that, is the onshore versus offshore yuan spread. And we were like looking at various indicators of like bellwethers of capital flight from China, because obviously most of it is not official. And one of the things that we kind of caught was that like Bitcoin had a really high correlation to the CNH CNY spread. It's just like a lot easier to move money in the Bitcoin than it is in like, bundles of cash strapped to your relatives or whatever. And so, I talked to Bob, who was the head of the currency department at the time. He's like, we should figure out what Bitcoin is. And I did a bunch of research on Bitcoin. I was like, this is super cool. Like, wow, look at all this stuff. Crypto, there's so much potential here. And like a lot of the stuff I, worked on at Bridgewater was long-term histories of currencies and financial systems and how they develop, and sort of like where we are in that process. And I thought Bitcoin was awesome. And then at a certain point, I presented all this research to them, and they were like, "Great! Like, how big is this market?" And I was like, "The whole market's like $10 billion." And they're like, "Why are we even having a conversation about this? This doesn't matter."
Yeah, so a couple of things there. So I've met a couple people from Bridgewater over the years too, and I found that all of them have been interested in crypto. And I guess I don't know that Bridgewater does anything today in crypto, but at least amongst Bridgewater people, they all seem to be interested in crypto. So that's a good sign, I guess. The whole thing you just mentioned there about kind of studying the history of currency markets. I mean, that sounds like a very Bridgewater type of thing. Given my understanding of kind of the culture there, I don't get the impression that like life as a Bridgewater analyst is similar to other kind of hedge funds. Like, what was your day to day when you were there? Was it a lot of this? I've read a lot of Dalio stuff. I mean, is it like kind of studying these market cycles and trying to port that onto the current times?
I mean, like,
how does that actually manifest?
It's changed in the different teams I was on. There's kind of like internal research projects, and then also they do like a daily Bridgewater daily observations, and I did a lot of work writing a bunch of those. Specifically, I spent a lot of time. Well, I spent time on a few ones that were like longer term, like history of currencies and like paper currencies versus gold and stuff. But then also I did a lot on like the UK, especially, and I was spending a lot of time researching the UK during Brexit and like coming up with like different kinds of like potential economic outcomes for them. So it also depends. Like, there's 3 separate departments. I don't know. They're really strict NDA stuff. I'm not sure how much I can discuss like the corporate structuring of Bridgewater, to be honest, on like a podcast.
Yeah, well, so I guess I am curious about the culture there, right? I mean, I read Principles back in college when it was still just a PDF, and I found a lot of that kind of influential. On the inside, like, was that a type of culture that you enjoyed working within? And do you find that you bring any of that to your day-to-day now, or other places you've worked at after Bridgewater?
Definitely. I think also it works less. Like, on the margin, there are probably some people who become more like Bridgewater-y, according to like what the culture is there. And like, it's in the case of like any company culture, like, it is aspirational, but it also has huge influence on how people actually act. And like, to a large degree, it is true that like the people are much more open with feedback. People are expected to give negative feedback, et cetera, et cetera. And, have like a really high bar. And there is this whole like rating system where you're constantly rating each other on like a variety of attributes and all this, which is like, I think great. Like, I think that like rating people constantly and like quantifying it is awesome. I think that like I'm like, then the other side of it, yes, I think so some people maybe become more that way, but I think it's more like people for whom that's a fit end up there or stay there, and people for whom it's not don't. Or like, I think that like I am somebody where I don't really consider myself super great at like reading people, or like I rely very heavily on like verbal communication. Like, I'm much more comfortable in an environment where I feel as though people are going to say what they're thinking, including negative input. And like, in an environment where I received a lot of like negative feedback, I know that people will tell me if there's negative feedback. So like, I think that it's a little bit less that I think people become that way by being there than it is that people for whom that's an attractive environment are more likely to end up there. And for the people for whom it's not, like, they just don't last. Like, it's just like, at least in like the IA program, something, I think like a third to half of people like get gone in the first year.
Yeah, that makes sense. When I was in college, I read 2 things around the same time. I'd read Principles when it was the PDF, and I had read Lying by Sam Harris, which I think is kind of like a dumbed down, 100-page accessible version of like Kantian philosophy. Mm-hmm. I think it's Kant, at least. I did not study economic or any kind of history like that. But I find them both kind of interesting because I think, in the Sam Harris book, his whole thing is like, basically you should never lie because you can never fully understand the second order consequence of a lie. And you just wind up having to kind of carry this mental baggage with you all the time of like, if you're lying all the time, you have to remember all these alternative like paths and storylines of, you told this person this thing and this person this thing. And you have to keep all of this kind of mental baggage in your head. And I imagine at Bridgewater, like, if you have this culture where everyone is so openly honest all the time, you can much more quickly get past, politics and some of that type of stuff. But who knows whether that actually manifests that way or not.
Yeah, I think it can exist in its ideal form, but the benefits of the ideal form accrue to some degree to the attempt. I guess as far as like personal values, honesty is probably number one for me. I've read Lying. I thought it was like, in general, I've enjoyed a lot of like essays by Sam Harris and stuff. I've read like 3 of his books, and I didn't like any of them. Like, all of his books for some reason just strike me as being like dumbed down. I really dislike the moral landscape. I think that it is making a weak version of the wrong argument for the point that he's trying to address. But like, I think like something else I would add to just like on like lying in general that I think makes it feel so. I think like the basic point of the like it's more of an essay I guess than a book. It's like it's very short.
Very short.
Lying is like broadly right, but something else that adds that I think that from like a moral perspective, feeling as though it is just for you to control and like mediate somebody else's access to reality. And like what their reality and their world is like at your discretion, I think is like a form of violence, like existential violence that like I find it really hard to like morally justify.
Yeah, I agree. Generally speaking, and I try to recommend it to a lot of people because it is very accessible, right? It's not one of his books that, I agree he can be a little bit kind of grandstanding or kind of high-minded sometimes, but I find that one to be very accessible. Okay, interesting. So actually, I guess just one last Bridgewater question. Have you ever kind of done the exercise of your own principles and written those out or anything like that? Or
I probably have. I don't know. It's one of those things like this is like the frustrating thing about like the principles, and I think like that is something of like quoting principles and stuff is something that is overdone at Bridgewater.
Really?
But it's like idioms and like sayings where like it's mostly stuff that you already know is obviously right. You know what I mean? Like. It's just like a reminder of stuff that is kind of obviously right. And there's some really funny errors in it though too. Like one of the things that people do and enjoy doing is like, making formal logic arguments with like a bunch of different principles. Like there's a really funny one that's somebody, because they hire a lot of like philosophy students and stuff, right?
Yeah.
Where they basically like reduced a bunch of separate principle statements into like formal logic and then like showed that the combination of them meant that pain equals pleasure. And there's another good one where I hope I'm going to get this right, but one of my old managers, or like old the person I was like directly reporting to, I forget what that term for that would be. But they also my direct report. I'm the person who's reporting to them. I don't know.
I think they're just your manager, yeah.
Yeah. Whatever. More of like anyway. So one of the principles, because they go from like obvious kind of like idiomatic, almost like truisms that like are like good reminders to like weirdly specific stuff also. And one of them is like end of year review should include little surprises, which is like clearly meant to be should include few surprises. And like he always would bring a little surprise for me and like quote that principle whenever we did like a end of year review, like a little like origami crane or something. He did like review
I will be honest,
little surprises.
That when you said that the first time, I definitely thought of his joke, not actually what it intended. I actually thought like small, pleasant surprises.
Exactly.
But I see. Okay, so after Bridgewater, you, if I'm getting my timeline here correct, co-founded another company, Omega One, which I think was broadly within the consensus ecosystem. How did that come to be, and what was that like?
That was with another guy from Bridgewater and two other folks, and basically the idea here was trying to fix the liquidity fragmentation in crypto, which like people complain about it now. Back then, like you could be a retail trader, like getting your face ripped off, market ordering on some of these exchanges. Well, that was back when like the deepest liquidity was on, gosh, what's it called now?
Bittrex?
Poly something?
Jesus. Poloniex.
Poloniex, sorry. There's like, now I was thinking like Polychain, there's always like poly things.
Yeah, Polygon.
And I was like, no. Yeah, so like I think Poloniex had like the deepest liquidity at the time, and like even then, like if you were doing like a $10,000 market order, you'd get like messed up. And so basically, you're trying to build like our execution management system for crypto, and then I ended up actually leaving it before we launched, mostly because like me and my co-founder wanted to do different things with it, and he wanted to go for like more of like a single big giant launch. So I was thinking much more like iterative, and he was like much older than I was, and I was like, hey man, I got a lot of shots. Like you can just take this one. I'm out. And then after leaving Omega. You already told me you're going to bring this up, so I'll just leave with it. You can bring it up.
No, please. So, I'll bring it up because listen, as I was going through your background, I thought this was actually incredibly interesting because also it's a topic that I'm personally interested in at the moment, so which is maybe why I found it interesting. But during COVID, it seemed like you founded a clothing company, actually, which is.
I left Omega. I was like taking some time off. COVID started. I was in LA, and I was like. Looking for projects to do for like a little while because like stuff's going to be locked down, and me and like my friend is also in LA, runs a clothing company, and I had an idea for a clothing company, and I was like, we should do this. He's like, it's actually a pretty good idea, and so I was like, we'll do this for like a little bit, and then ended up like COVID was like 2.5 years, so I did that for like 2 years. I'm actually wearing one of the products right now. This is the Kinto shirt. Yeah.
So what was the initial like thesis of the clothing company? Because in reading through some of the blog posts and stuff on your Medium at the time for it, I got the impression that it was a very strongly opinionated clothing company. just in terms of
I think I'm pretty strongly opinionated in general. And there's a few things. So some are more product specific and some are more clothing specific, and some of it has to do with the industry in a way that doesn't necessarily even directly address the company itself. Product wise, part of it is I actually wanted like good banded color shirts, and so I just wanted to make one. This is something that my brother always like makes fun of me for, where he's like, "You wanted a specific shirt, and then you started the company to make it." And I was like, "Fair enough." And there's a whole case around why that, which we can not go into maybe. And then there's kind of like how the clothing design process works, and basically there are a lot of problems with the incentive structures of clothing, where it basically, as it's structured right now, reduces itself to being more or less disposable. And is not iterative, does not improve over time, is not a progressive. Like this is a thing that kind of comes up when it's something that I think I did a bunch of research on once, like a long time ago. I got really interested in it. But like pre the invention of photography, you can view painting as like a progressive art, or it was trying to more accurately represent reality. In an earlier sense, that was like very much tied in with like worship and like capturing the glory of like God's creation or whatever. But like even then, simply from a craft sense, it like a better painter was somebody who could do a better job representing reality. And it really like very quickly, once photographs were a thing, painting totally stopped being a progressive art where it had like particular goals just progressing toward, and just became about expression. And then like representations of what's going on in culture and those kinds of things. And that's how we got like, you know, the expressionists, et cetera, up through like the Dadaists and like, you know, modern abstract stuff we have today, Jackson Pollock and all that stuff. There's obviously a lot of other input to that, but like it's an interesting pin to put in it to like see the change from a progressive art to a non-progressive art. Anyway, clothing manufacturing is not a progressive art. Like clothing does not get better in the way that we're doing it right now. Over time, it gets cheaper.
Yes. Could we maybe define better in this case? Is it better materials? Is it better? Like better in what respect? Yeah,
so I'll say better in terms of like better suited to specific use cases. Like a big part of like what clothing does is it communicates things about yourself, like whether or not you're intentionally doing it or consciously doing it, you are doing it. You're communicating like symbolically or like semiotically things about yourself in the way that you present yourself, but also just in terms of like quality and stuff that will like last a long time and like not break. And like is comfortable and that you can wash forever and like isn't going to fall apart and all that. There are exceptions to this stuff, but like the clothing industry is dumpster fire. And another thing that was added on top of that at the time, so I was also interested in doing something that didn't involve raising any VC capital. And I'm pretty strongly opinionated about like there are businesses and markets for which VC capital makes sense, and business and markets for which it doesn't. The problem with something like a clothing brand, and I wrote a whole article about like Outdoor Voices as an example of this is the incentives of like a founder do not line up with VC, where you can have a clothing brand that's doing like 7 million sales, like clearing a solid profit for you that like you can run with minimal time. It's like a great lifestyle business. It's really productive, which also makes a lot more sense if you have a very specific market that you're addressing and you capture that crowd, you have like really, really true fans, you continue to serve them, you're going to have a great business. For a VC, if they put a bunch of money, that's equivalent to zero for them. Like it's only interesting to them to get to, you know, $1 billion IPO or whatever at some point. And so like blitz scaling in clothing basically means that you're going to be overspending in a way that's probably like reducing the unit profit, probably turning to negative unit profit and like anticipating and pushing toward growth, which starts out with like really, really high CAC, low hanging fruit. And eventually, because the easiest metrics to present to VC investors who you're going to have to go back to because you're now a non-profitable business is stuff that you can measure like online advertising that creates like a self-reinforcing cycle where maybe there's network effects in clothing, but like it's not a social media app, you know?
Right. And I guess broadly I run a business. I haven't raised venture capital. I think largely for a lot of the same reasons that you said, which is like, for me, it's very clear that venture capital exists to, or should exist to, metaphorically pour gasoline on a fire. But like you need to have kind of the kindling and the fire in place and, you know, a foundation that's not going to burn down a forest and like all this other kind of stuff first. And that just like raising without kind of fully understanding the then expectations and consequences and responsibilities, I think is, you know, kind of a tragic thing for a lot of people. And in the case of this clothing business, right, $7 million a year is a great business, take a nice dividend every year or something, but in the venture case, you know, now you have to, you know, maybe do things like...
If you have really, really high audience loyalty and audience that your product serves, and then you have to reach new audiences in order to meet growth targets, you have to change your product, which means that you're going to stop serving your core audience.
Yes.
Which that's like
it could, yeah.
on like the market, right? Like that is, I think, very true in like clothing, where like you can have a brand that really, really appeals well to a specific niche, or you can have a brand with generic appeal. It's a little bit like, you know, people always complain about like what's going on with like movies right now, where they're so high budget that you have to make it generic, right? And so like it's really hard to have like new like original scripts and stuff. It's like sort of an equivalent of that. And again, like there are sort of like versions of this that have worked out. Like I feel like this isn't clothing, but like Dollar Shave Club is like kind of an example. And I know that I might be mixing up that and like Harry's, and like I think one of them had like an antitrust problem or something. So like I forget which one of those it was. Like this is all years ago. But I think there's sort of like there are if you're gonna all the stuff you just said about like raising VC capital, but I would layer on also it really depends on like the market and the specific the business you're doing. Like if you were the first dog walking app, raise VC capital, because like either everybody uses your app or like they don't, and like you're the one that everybody recommends to everybody, that everybody's used to using, that all the dog walkers know is the only place to go, where you can in any city in the US find a dog to walk, even if you're on vacation, to like get a little capital. Like that makes sense. A lot of crypto cases, I think it makes sense. Obviously, crypto's a different situation where there's also all these like weird alternative paths, or less so ICOs now. Pretty soon initial points sales, surely. But yeah, I don't know. It's do not necessarily default to raising capital if it doesn't make sense for the business you're running and for your goals for the business.
Right. So back to the clothing brand, just kind of for one kind of wrap up question here, which is, it seemed like one of the interesting concepts you guys were trying to pioneer was around participatory design, if I'm kind of saying that correctly, where the concept is, people have a higher loyalty or buy-in to something that they feel like they were a part of the design process of, or part of creating it. I believe that generally, right? Like there's this whole trend of kind of like people hunting their own meat, and you eat the cow that you raised and killed, and just as a tangential example, I guess. But I believe that generally. But how did that kind of play out in practice for you guys? Was it actually too many cooks in the kitchen, or did it work?
Didn't do it long enough for it to really play out. Even with optimizing for having faster, like doing really small orders and having like faster design turnover, it's just a slow process with clothing. In a way that, because like the idea was like, can we make something like that a couple notches closer to something like software, where there's like really fast feedback loops. I think there's a missed opportunity in software where like people might be more attached to products if they knew that their usage of it was driving how it was developed in a more transparent way. The problem is a lot of the stuff that they're capturing for that is creepy and is not like, you gave us a really good tip and we changed it. It's like, oh, we tracked your eyes, and over the past 2 years we decided to like move this button. And so like I guess there's like problems with like communicating it that way, but like I do think it is the case that people are more invested in something that they feel like they participated in and like been incorporated into the design of. I'm sure you're going to segue this into like crypto, and like 100%.
Yes.
Yeah.
How did you know?
Yeah, but yeah, I don't think it really worked for clothing. I think that in order to do it well for clothing, you'd have to already have a really large audience and have a lot of capital. So like it makes sense like a thing for clothing brands with an existing audience to do, but it's kind of hard to start out that way.
Huh. Okay. Got it. Yeah. So I guess to wrap that up, I was going to transition it into crypto and kind of actually come back to that. But is there anything there to kind of think about within the DAO space, just in terms of, how these people get involved, how token ownership maybe kind of increases that, or like, I feel like we haven't really seen the positive case of that participatory design too much.
Yeah. I mean, I feel like there's, I don't know if we're going to start a conversation about like DAOs, but I mean, there's going to be a DAO for Kinto. I think that DAOs are definitely figuring out how they need to work. It seems to me like a lot of what DAOs do is kind of like slowly reinventing a lot of corporate structuring with like a sort of like equivalent of a shareholder class, and an equivalent of a board, and an equivalent of like a CEO and like directors for various functions, and like also committees and like to do certain things. Like it seems like they're rediscovering a lot of that. Like I am not a believer that like liquid democracy is like a good system. But yeah, so there's a lot to explore there. I think that like in general in crypto, something that is like not just like people have tokens and like have like voting rights and things, but also just like the sort of like default existence of like a Telegram group or like a Discord for a community where like any product you use almost in crypto, you can probably go join a Discord that has like 50% of all the users of that product in it or more that are like talking about it and like care about it. And part of the reason they care about it is because they have a place to talk about it.
Okay. Yeah. I feel like there's kind of two sides to that. I mean, one, there's maybe it's just to sort of consequence of some communities. I mean, I do know, or I at least believe that places like Synthetics that I think have kind of fostered very strong loyalty of their community probably do have more like beneficially participatory design. I would say probably most places have more like negative participatory where like the feedback isn't
That's
always
true. Yeah,
super
there
actionable,
are a lot
but
of not great Discord communities. So like I guess there is like I'm describing an idealized version of this to be sure.
Yeah. Okay.
That's something I'm actually really interested in for Kinto. Is I do wonder, like right now, we have a Discord. Whatever, go to our website, join Discord. But
yeah.
I'm sure that at some point we'll have a Discord where people who are like KYC verified have like a channel. I'm really interested to see what that channel is like versus your average.
That actually does sound kind of interesting to have basically a verified user channel type of thing. Which some people have like token gating and stuff, but yeah.
I mean, like one of the things, like we are exclusively focused on like financial products, but like there is a whole conversation about like whether there should be, proof of humanity versions of like social media products.
Yeah. So before wrapping up, kind of back on some Kinto questions, I want to talk on Sense Finance, because that is where you and I actually might have met when you were out of Mega One. I don't think you remember, but we definitely met when you were at Sense. How did you wind up at Sense, and what was the original vision there when you joined?
I might get how I wound up there wrong, but I'll have most of the details right. So part of it was another thing that I really like in general are interest rates. Spend a lot of time thinking about interest rates and currency forwards and forward rates and stuff. I think it's like one of the most like beautiful, like emergent things of our financial system. But I decided I wanted to like learn some coding basics. Like I've done like multiple coding schools. I am the smooth brain, non-technical person, but like I want to have like some degree of literacy. And I did one in Solidity because I'd already done a bunch of JavaScript and stuff. And you do like a final project for whatever. And I basically built a yield stripping protocol. And the basis of like my reason for building a yield stripping protocol is I thought it would be really cool to be able to have fixed rate equivalents of staked ETH, and then have like forward rates on staked ETH. And this is sort of like, I think this was before the merge actually happened, or maybe right after, where I basically view like the Ethereum staking rate as the risk-free rate of crypto. It's like it's like a place where you can have for like the underlying asset of the largest crypto economy, yield paid by the issuer of the currency in which the yield is denominated, which is ETH, paid by the network itself, which has all sorts of like interesting pricing implications versus the dollar, where like the initiation of the merge is basically equivalent to there being like a 3 to 5% tightening in like an emerging market central bank versus the dollar. Incidentally, it turned out that the dollar also tightened like around 5% at that time, so didn't get to see it play out with like all the variables controlled. But anyway, sorry. So I basically built a yield stripping protocol, and I wrote an article about why that would be like an important thing to build. And either somebody at a VC read that article, or one of the guys in that class or who did the project with me knew that person at the VC and like introed me, and they were invested in Sense. And they're like, I am invested in a company that's doing this. And I was like, oh. And so that's how I ended up at Sense.
Nice.
So they've actually pivoted, but at the time they were a yield stripping protocol in Ethereum.
So going kind of from the experience at Sense, coming back to Kinto a bit here. You've now worked on applications, so Sense and Omega 1, now in L2. What are the biggest, I guess you could say, differences in kind of the go-to-market and development between building a user-facing application versus building kind of a whole ecosystem around an L2? How has that experience been different for you?
I think building a network is a lot more complicated, because when you're building a network, yes, you are building a product. You're building a product that's used by protocols, and to some degree used by users, because like how we built it affects the user experience for individual users as well as the building experience of protocols and whether protocols want to build on Kinto. Not even talking to the fact that we're also looking at multiple audiences for each of these things in a way that's also really interesting. Or like, so something that I've always thought was like, well, one of the few really appealing things that people who do work in the VC space is they get to go talk to all these different companies and like see all the stuff that's happening in the space. And like, I've talked to a lot of the existing or soon to exist real world asset companies in existence through working at Kinto. So there are perks to the fact that it's like a lot more complicated. But then also going forward, and like we're just barely pre-launch. Pretty soon we're going to be live. There will be the DAO. There will be token. There will be our existing protocols and like what our existing TVL is and stuff. And at the end of the day, like, probably to the point of we described a ton of different stuff that's interesting that can be built on Kinto in the future. And I even talked to you about how I think that the most used apps on Kinto at launch are very different from the most used apps on Kinto a year after launch versus 3 years after launch versus 5. Like, I think those are all going to look really, really different. And like the primary thing that's going to lead to Kinto succeeding or not is, to the degree there is a team who is building that thing that is going to be the most important thing on Kinto in 12 months. We need to make sure they build it on Kinto. And like that's you don't get that kind of problem as a dApp to solve. Like that's a network problem.
So I guess, of kind of the diverse experiences you've had across hedge funds and entrepreneurial and, working at Sense, would you say that that's kind of what drew you to Kinto initially, or was it something else? That I guess you could say kind of broad challenge set of kind of being able to touch all these people and, build this whole kind of broad ecosystem, or what was it that attracted you?
That's something I don't think I really thought about that much until doing it. What really made me do Kinto is basically, as I mentioned before, we were kind of doing all this sort of research into what's missing in crypto infrastructure. And as soon as we came up with this idea of let's maintain permissionlessness, but have a fully KYC layer 2 built on top of Ethereum, that was it seemed like such an obvious need and gap that unlocked so much design space and solved so many problems that we heard people describing the RWA space and among TradFi investors, etc., that we were astonished that they didn't already exist. There wasn't already a team doing this, to the point where I was going and first of all, trying to figure out if the team was already doing this, and then going and talking to friends of mine in VC and stuff, and they'd seen deal flow of people doing this, and no one was doing it. And it just seems very obviously the thing to build. And I think it's good. Generally speaking, if you have an idea that once you land on it seems really obvious, and then somehow nobody else is doing it yet, that's probably the kind of idea you want to pursue.
Yeah, it does actually kind of surprise me a bit. And I couldn't tell you why, but one of the things I think is interesting about Kinto is that compared to a lot of the general purpose L2s that are out there, you guys are definitely making decisions and doing things that could only exist because of an L2. So, I think putting aside however people feel about the KYC aspects, at the very least, I think people should definitely encourage this kind of experimentation on, that is uniquely enabled by L2 architecture.
Yeah, totally. I think I would have no interest in building a version of Kinto that was a separate L1. I only want to build it as a part of the Ethereum ecosystem. And then having also, gotten pretty deep in a variety of different L2 ecosystems, it was a very well considered and one of the most confident in terms of having put the thought into a decision to go with Arbitrum. I think that for us, building this only makes sense as an L2, and as an L2, it makes sense to do it as an Arbitrum L2.
Yeah, I got that impression from just kind of having talked to you guys a bit through that process and seeing a bit from the outside kind of your decision. So that was very exciting to see. And hopefully by the time you guys launch, it will still be the first one using the Arbitrum L2 stack. I think that will be very exciting.
Yeah, I think probably will. But I think it will not be the last.
Yeah.
Now they're kind of more open to doing this. I think that this is the right move for the Arbitrum foundation for the ecosystem. All
right. Well, to finish up, what are the big milestones that people should be looking for with Kinto's development, launch timelines? What should people expect? How can they get involved?
So I'm not sure what the lag is on this coming out.
I'll probably post it on Friday, so 26th, let's say.
Okay, so there's some chance that there will still be spots open left from the ones we release on Wednesday, which you can find at engen.kinto.xyz. I'm sure Ryan can add a link to that. If you miss out on that, the next time to then get spots is going to be in February, and that's going to be one that also specifically rewards folks who have been exploited in a DeFi hack of some kind. So if you're part of any community where haven't exposed any of those, make sure to come join the Kinto Discord. I'm sure that we'll have a link to Kinto, which is www.kinto.xyz, somewhere on here. And after that, mainnet launch is going to be likely April 1st. We will be fully out there, and people who have gone through and done pre-verification on KYC will be able to pre-commit capital before that.
Maybe go April 2nd, just so people take the date seriously.
That's a good point. I honestly hadn't even thought about that.
It's the first thing that came to mind. But all right, well, Alan, and how can people follow you? Twitter, website, where's the best place to learn about you?
At Mr. Keegan, Mr. spelled out MisterKeegan.
Okay. All right. Well, technical difficulties aside, Alan, thank you very much for joining me today. Enjoyed the conversation and excited to continue working with you and Kinto.
Yeah, thanks for having me.
All right. Talk soon.